Welcome to another audio article from The Intelligent Speculator. This article was published on May 12th, 2020, and the title is The Holy Grail to Growing Your Wealth Exponentially. So let's get right into it. Risk and reward. How you execute on the relationship of risk and reward will in many ways dictate how well or how poorly your wealth will perform over time. As a speculator in markets, I've been able to make consistent profits for almost a decade, but it's not because I've been right all or even most of the time. In fact, how I trade and invest allows me the option to actually be wrong most of the time and still remain very profitable. It all has to do with this basic idea. Only take positions where my downside risk is limited and my upside reward potential is significantly higher than my risk. If I'm about to take a position, any position, whether that be currencies, commodities, or stocks, I make sure my risk is set and controlled as much as possible. Which means I have controls in place that if I am wrong and the investment or trade goes badly, that I lose only a set amount of money. To make this illustration easy, let's say I find a long or short position in a market or commodity that I want to take. I will make sure my risk is set at no more than $1. That means if I am wrong, the worst case scenario means I lose just $1. Most people enter their investments or speculations without any set limits on how much they're willing to lose. And that is the number one fatal flaw for the naive investor because they open themselves up to almost unlimited risk of losing their financial resources, which means being wrong with a single time can cause devastating financial consequences. It would be both arrogant and foolish to think that we know the future 100% of the time. In fact, one thing that I've learned over and over again through trading is that the best you can do is give probabilities to certain events playing out. Because we know there are no certain things in life besides a casket and a tax collector. Now you hear me say something has a 75% chance of happening. And take that as almost a sure thing and go all in on this high probability event. However, what if in some scenario I told you you had a 25% chance of dying tomorrow from walking down the street? That's a pretty scary probability because while still a fairly low chance of happening, it's still not that low. And it is more likely than not would cause you to recalculate significantly on whether it was worth walking down the street tomorrow at all, and what mitigating efforts you could take to protect yourself if you had no other choice. Hence, you would still do everything possible to reduce your risk. Limiting your risk. Risk is the first thing an intelligent speculator calculates before taking a position. Making sure the risk is limited provides a very limited financial drawdown on their wealth should the position go bust. Because the hardest thing to do is make up for money that has been lost. Meaning if you lose half of your position on an investment, then at some point you would have to hit a home run of 100% return on your remaining capital to break even again. You may get lucky or you get your money back once, but over the long term, that is a recipe for financial ruin. Now, once a speculator has risk control in place, the next step is calculating your potential reward on how much money you will make if your trade or investment is correct. Let's revisit the earlier example of controlling your risk for $1. You have to ask, what should my potential reward be if I'm willing to risk $1? For example, should I be willing to risk $1 if I'm wrong, but make 10 cents if I'm right? In that scenario, I would have to be right 90% of the time over the long run just to break even. Now, perhaps you are the modern Nostradamus, but I'm not God's gift to fortune telling. In other words, betting $1 trying to make 10 cents would be unintelligent speculating on my part. However, would I be willing to bet $1 with the prospect of winning $1? I would need to be right 50% of the time to break even. And as long as I can be right more than half the time, I can at least make a little bit of money. Granted, that's better than the 10 cent scenario, but I still don't like the pressure of trying to be right 50% of the time. Speculating on the future, it's a tough business, and even tougher than most people realize. In fact, that's why most folks just simply can't beat average equity returns, because we're human beings that lack a crystal ball. However, I have learned that if you're going to take a position where I have $1 at risk, then I only make trades or investments where my potential payout is going to be at least $2 if I'm right, but preferably 3 or 4 or more, all while keeping my risk at $1 if I'm wrong. And when someone can move your money into high probability investments and trades with that type of risk reward management, that is how significant wealth is built. If we want to be intelligent speculators, we need to have the humility to take certainty out of our vocabulary and replace it with probability. Once we see high probability events start to unfold, we move into financial instruments with controlled risk that provide a very high potential return. How do we determine a high probability event? Well, that's a story for another day. Stay tuned. Thank you for tuning in to another audio article. If you would like to take a minute to like and subscribe, we would appreciate that, and hit the bell icon if you want to be notified when new episodes are available. If you would like to learn more from the Intelligent Speculator, feel free to join with our exclusive Facebook group and interact with Lathan Fritz, the Intelligent Speculator himself, or keep up to date with us on Instagram, Facebook, and Twitter. Good day.